Let's talk about a silent change. It's a shift that doesn't make headlines, but it happens almost invisibly, and it affects nearly everything. You see, banks don't really make big announcements when they decide to become more cautious. They don't need to. Instead of words, they just act. And you start to feel it. You feel it in the approvals. That application that might have sailed through 6 months ago, suddenly it needs a second look. The bar for getting a yes just gets a little bit higher. You feel it in the limits they offer. The credit line is just a bit smaller than you expected. The loan amount isn't quite what was possible before. And you definitely feel it in the requirements. All of a sudden, they need one more pay stub, another reference, a deeper look into your history. The bar is quietly but surely being raised. And here's the thing. By the time it's obvious to everyone what's going on, the change isn't coming anymore. It has already happened. Borrowing has already become harder. Welcome back to Finance Deep Dive. Now, last time we talked about Social Security and long-term stability, but today we're shifting to something a lot closer to home: credit. Because when banks quietly change their behavior, the rest of the economy always follows. So why is this quiet little shift so important? Well, because credit is, quite simply, the fuel of our modern economy. It's the whole mechanism that lets us use our future earnings to build something today. And we're not just talking about credit cards here. We're talking about the fundamental driver of almost all major economic activity. I mean, just think about it. Credit is what powers the purchase of homes. It's how we buy cars. It's what allows new businesses to get off the ground and for existing ones to expand. It is literally what turns plans into reality. So it stands to reason, right? When access to that fuel gets tighter, economic activity starts to slow down. It's not some overnight crash. It's this gradual creeping slowdown that you might not even notice day to day. So how does this whole process actually begin? It rarely starts with a big wave of rejections. No, it starts with something much more subtle. Just small, intentional bits of friction being added to the system. These are the very first signs. The loan officer asks for one extra document. The underwriting process that used to take a week, well, now it's taking 2. The minimum credit score you need for the best rates just inches up. Each one of these steps, on its own, just feels like a minor bureaucratic hurdle. But this friction isn't isolated. It starts to spread from one department to another, from one bank to the next. And pretty soon, it's creating this collective, systemic drag on the entire lending world. Which brings us to a really crucial question. If this is all so important, why do so many people miss it until it's too late? Well, the answer is all about the nature of the signals themselves. See, we're all conditioned to look for the loud signals, the dramatic headlines, the market crashes, the emergency alerts on our phones. But credit tightening works with quiet signals, slightly fewer approvals, maybe smaller offers, a little bit higher requirements. It's the exact opposite of a market panic. So, as an individual, you might see a smaller loan offer, and you just adjust your plans. It feels manageable, right? But when millions of people are all doing that at the same time, the entire economic momentum of the country begins to shift. Okay, so what does this signal actually mean? Why are the banks adding all this friction in the first place? Well, it's all about what they see coming over the horizon. And this is the most crucial point to understand. Banks are forward-looking. They tighten their lending because they expect an increase in future risk, not because the risk has already shown up in a bunch of defaults. And that's why paying attention to this is so powerful. It's a leading indicator. Their behavior changes before the economic reality becomes visible to the rest of us in job numbers or company earnings. So we've covered the what and the why, but let's bring this all down to the most important level. What does it actually mean for you? Well, when credit becomes harder to get, your financial flexibility shrinks, plain and simple. Your options for buying a home, for starting a business, or even just for managing an unexpected expense, they start to narrow. And every financial decision you make starts to carry a lot more weight. And again, it's not some dramatic overnight change. You're not going to see a news alert about it. But the impact on your ability to navigate your own financial future, well, that's incredibly powerful. Credit tightening is rarely loud, but it can reshape what's possible. If this video helps you see something earlier, hit like. It tells YouTube this conversation matters. And comment below, have you noticed lending getting stricter recently? And subscribe to Finance Deep Dive if you want to stay ahead of these quiet changes.